Welcome back, everyone. Today's explainer tackles a truly fascinating mystery I've been digging into lately regarding the semiconductor space. We're looking at Broadcom, ticker symbol AVGO, and this massive, sudden stock drop that honestly caught a lot of people totally off guard. But look, this isn't just about a bad day in the market. It's about uncovering the hidden AI financial plumbing. You know, those off-balance sheet mechanisms that are quietly reshaping how this entire artificial intelligence boom is actually being funded. So if you want to understand the real, fundamental risks behind AI infrastructure, you are in exactly the right place. Let's dive in.
All right, here's our game plan for today. We'll start with the Broadcom price mystery, then unpack those hidden AI debt risks, look at how they're mitigating that tail risk, calculate the intrinsic value, do a technical analysis breakdown, and wrap up with a final investment verdict.
Section 1. The Broadcom Price Mystery.
So, the big question. Why on earth did a highly profitable AI giant suddenly drop nearly 7% in a single day, plunging all the way down to $392.99? Broadcom isn't some speculative fly-by-night startup, right? It's literally a cash printing machine. When a company with this kind of impenetrable moat experiences a sudden, violent intraday sell-off like that, it absolutely demands our attention. We really need to look under the hood here.
What we had was essentially a perfect storm. Three core catalysts triggered the panic. First, Wall Street analysts, led by Bank of America, started ringing the alarm bell regarding AI debt financing scrutiny. They were pointing specifically to massive structured debt vehicles involving financial giants like Apollo and Blackstone. Second, we saw sudden anxieties over gross margin mix shifts. Investors started worrying that Broadcom's custom AI silicon, which carries slightly lower margins, might actually drag down the hyper-profitable software margins they get from VMware. And third, well, you can never ignore the macro environment. We had weak U.S. retail sales coming in at negative 0.6%, which surprisingly dragged down high-beta tech names across the entire market. It just goes to show that even the most intense AI hype isn't totally immune to basic consumer spending trends.
Moving on to Section 2, Hidden AI Debt Risks. $700 billion. Let that number sink in for a second. That is the staggering theoretical residual value exposure Broadcom could face if it has to guarantee over $1 trillion in cumulative chip deployments by 2030. Wall Street analysts saw this theoretical ceiling and it completely spooked the market. But to understand why it's such a big deal, we really need to unpack the structure holding it all together.
Let's bust some financial jargon really quickly. What we're talking about here are SPVs, or Special Purpose Vehicles. Basically, these are subsidiaries created to isolate financial risk. In this case, they're being used for massive $35 billion plus deals involving private credit firms like Apollo and Blackstone. Now, while an SPV legally keeps that massive mountain of debt off Broadcom's official corporate balance sheet, credit rating agencies like S&P and Moody's, they aren't fooled. They look at Broadcom's contingent guarantees as basically being debt equivalent. So if the market suddenly perceives Broadcom as a de facto insurer of AI hardware debt, their credit rating could take a serious hit, making borrowing way more expensive and potentially crushing their valuation multiples.
So how could this actually blow up in their faces? We call this the structural trap. Step 1, let's say a major frontier AI lab, let's just use Anthropic as a hypothetical example here, defaults on its obligations. Step 2, this bankruptcy likely happens right alongside a broader AI sector downturn or a sudden technological shift where current TPUs become completely obsolete. Step 3, because of that obsolescence, the secondary market value for those used customized TPUs completely collapses to near zero. Nobody wants them. And Step 4, Broadcom, having guaranteed the residual value to those private credit lenders, is forced to step in and absorb a massive cash deficiency right when its core revenues are dropping. They are essentially taking on bank-like default risk for a standard hardware margin. Yikes.
Section 3. Mitigating the tail risk.
Now, take a deep breath. Broadcom is not walking a tightrope without a net here. First off, there are multi-layer backstops in place. These custom chips are heavily co-developed with Alphabet and Google, who often provide underlying lease or compute guarantees, so before Broadcom ever pays out a single dime, those chips would likely get released to other cloud providers. Second, Broadcom is an absolute free cash flow machine. They're expecting over $35 billion in free cash flow by fiscal year 2026. That is a massive financial buffer that most tech companies just literally do not have. And finally, that $700 billion doomsday scale, it's largely unrealistic. Broadcom uses these early SPVs to kickstart the market, sure, but as the custom silicon market matures,
Institutional private credit syndicates will gladly step in and absorb the unbacked risk, which severely caps Broadcom's actual, real-world exposure.
Section 4. Calculating intrinsic value.
Now, what's really fascinating here is the stark contrast in valuation methods. On one hand, we've got a strict, conservative, discounted cash flow fair value. This relies on historical trends, an 18 to 22% free cash flow growth rate, at a 10 to 11% weighted average cost of capital. That WACC is essentially the minimum return investors expect, acting as a heavy anchor keeping our estimates grounded in reality. That math gives us a rock-solid floor of roughly $380 to $410 per share. But on the other hand, we have the Wall Street consensus targeting $526 to $528, which aggressively prices in their AI growth at a 25 to 28 times forward PE multiple. Remember, the price right after this massive drop was roughly $392. This brilliantly illustrates that Broadcom was suddenly trading right at its absolute most conservative intrinsic floor.
And let's actually validate that floor by looking at their fundamental financial metrics compared to the rest of the sector. Look, despite carrying $65 billion in long-term debt from that huge VMware acquisition, their balance sheet is remarkably safe purely because of their insane cash generation. Just look at that EBITDA margin, which is basically their pure operational profitability before accounting for interest or taxes. It's sitting at roughly 55% compared to the 30% sector average. That is industry-leading efficiency, no question. Their enterprise value to EBITDA ratio is an attractive 19.2 times. But the absolute standout, the real star of the show, is the free cash flow conversion at over 40%. Broadcom just operates with elite cash generation, giving them a net debt to EBITDA ratio that remains incredibly manageable.
Section 5. Technical Analysis Breakdown. All right, let's map out the battlefield for the technical traders out there. With the price hovering right in that 392 pivot zone, we're looking at an RSI, our momentum indicator, that has pushed down very near oversold territory, sitting somewhere between 38 and 42. Beneath us, we have a vital support zone between 388 and 390, which is heavily defended by a thick cluster of options. If that level breaks, we have to look down to the 375 to 378 level, which acts as a massive structural support backed by the 50-day and 100-day moving averages. Above us, well, the immediate goal for bulls is getting that gap fill between 405 and 410. If they chew through that, 422 is your true breakout target.
Now here is where the technicals get genuinely fascinating. 233,000. That is the massive surge in call option contracts that flooded in during the sell-off, heavily concentrated at the $400 strike price. What I found incredibly surprising here is a glaring anomaly in the market. Typically, when a stock drops nearly 7%, panic sets in and implied volatility spikes. But here, implied volatility actually decreased. A volatility crush happening right alongside massive call buying strongly signals that institutional money was quietly positioning for a rebound, not panicking. They were buying the dip.
So the crucial point for you traders is execution. Here are your two concrete trade plans side by side. If you believe in that institutional call buying, the bullish rebound trade is to enter on a confirmed hourly reversal right near that 388 to 390 support zone. You target 408 for the gap fill, and you absolutely keep a tight stop loss just below 384 to protect your capital. On the flip side, the bearish breakdown trade dictates that if the price closes below 388 on heavy, sustained volume, you should expect a rapid, pretty much frictionless drift down to that pre-75 structural support.
Finally, Section 6. The final investment verdict.
So, what should you actually take away from this explainer? Well, it really depends on your time frame. For short-term traders, the technical setup is heavily oversold right now. That institutional call buying around the $400 strike strongly points to a potential relief bounce toward the 405 to 410 level, provided that 388 support holds firm. For long-term investors, honestly, the noise is just noise. The underlying fundamentals, especially that crazy 55% EBITDA margin and elite cash generation, they remain entirely intact. Broadcom is trading right near the bottom of its historical intrinsic valuation band. If you can stomach the short-term volatility regarding those AI get structures and private credit SPVs, this dip represents a highly favorable dollar-cost averaging opportunity. But before we wrap up, I want to leave you with a larger philosophical shift happening in the market. It's captured perfectly by this quote from our sources. The financing structure acts as a double-edged sword. It turns Broadcom from a pure hardware supplier into an underwriter of credit risk for AI startups. Think about that. This isn't just about selling silicon anymore. It's about who actually holds the bag if the music suddenly stops.
Which brings us to our final thought for today's explainer.
As the AI bubble inflates, are we really comfortable with hardware giants quietly becoming the financial underwriters of the future? It's a massive evolution in the fundamental business model of the tech sector, and it's one that every single savvy investor needs to be watching incredibly closely. Thank you so much for joining me. Keep studying those charts, and I will see you in the next explainer.